So we're delighted to have all of you here. This is the 4th annual Microlumbia Conference. And Microlumbia was started 4 years ago with the goal of spreading the message about microfinance amongst Columbia students and the New York community. And we're delighted to be able to hold this event and have such distinguished speakers.
And just to echo Lucy's words, we're very thankful that all of you could join us, and we're very thankful of the impressive lineup of panelists that we have here today. And thank you very much to Deutsche Bank, of course, our sponsor. And we just wanted to encourage everybody to, we want to take advantage that we are a nonprofit, we're an educational institution, and we really want to encourage, constructive discussion about the issues concerning microfinance today. So please contribute with your thoughts and your questions. And we dare you to challenge the speakers without being rude. But
it's so easy for him to say that.
A little rude is okay.
So welcome and thank you again. And
thanks.
We'll feature our first panel. We'll give to Professor Suresh to make the introductions.
Okay. Well, thank you very much for having us here. And first of all, I want to acknowledge the hard work that has been behind this conference by the student organizers, without whose effort I don't think this would have been possible. So I want to congratulate all of you. And as part of Columbia community, I take great pleasure, and it is my privilege to welcome our panelists today to this microfinance conference. My job today in the panel is to serve as a moderator. And I thought, as a moderator, I would not simply take the view of a gatekeeper or a timekeeper. I'll take a slightly more active role, if that's all right with the panelists. And I thought what I would do was to sort of take the audience as well as the panelists through some facts and figures and some transition issues that may be relevant in thinking about the topic that the panel has been provided with. So let me first start with some stylized facts. Based on CGAP report over the last 15 years, about 100 NGOs have reported that they have transformed themselves into cooperatives, banks, or non-bank financial institutions. And of course, a few of the NGOs have gone all the way and gone through an initial public offer, Bank Compartamos being one, and we are very fortunate to have a representative from Bank Compartamos. And of course, last year, SKS performed an IPO, very successful IPO in India. Now, of course, if you look at the reported data in CGAP, what we note is that NGOs account for about 37% of all microfinance institutions. Non-bank financial institutions account for about 30%, and the remainder is made up of credit unions, cooperatives, rural banks, and the rest. Now, if you think about the mission of an NGO and its special status in any society, typically they are tax-exempt organizations. So one might say that government has had a role in promoting the activities of the NGO. And of course, NGOs are typically there for community empowerment. Access to financial services being one, but not necessarily exclusive. Access to education, health, infrastructure could be other mission objectives of NGO. So when donors and grantors give money to NGO, they have certain expectations that the NGO would fulfill going forward. But the NGO itself, as we have seen, may have other aspirations, and it may want to transform itself into a for-profit organization. So when this transition occurs, the original objectives of the donors and the grantors may or may not be fulfilled. And that is one of the challenges that we need to address in the transition process. I'm not suggesting that it's a bad idea for an NGO to become a bank or an NBFI. In fact, there are very good reasons why an NGO might want to expand the services, to be financially independent, to be free of donor or soft capital. But what we are looking at is that as the NGO goes through this process, we are bringing in additional stakeholders. Over and above the original donors and borrowers, we're bringing in capital providers. They could be private equity capital providers, debt capital providers, and of course, ultimately in an IPO, equity holders. And in some countries, for example, in India, government itself sets up institutions to help an NGO to transform itself into a non-bank financial institution. So one might ask, well, what should be the stake of the government in this process as well? So I just want to start with that broad background, and what I would like to do now is to let each of the panelists present some opening remarks, giving their thoughts on this issue as well as some of the other issues that are before us.
Thank you very much. My name is Greg Casagrande, and I am the founder of South Pacific Business Development Microfinance Network, or just SPBD. SPBD is a private, independent microfinance network that operates in the Pacific Island countries of Samoa, Tonga, and Fiji. It was founded in 2000 by me. It's been independently funded and privately funded since inception. We started off as a NGO in Samoa. We have since transformed, and today we have a holding company in Singapore that owns 3 independent non-banking financial institutions in each of Samoa, Tonga, and Fiji, and we are gradually spreading throughout the Pacific Islands region. The organization is traditional microfinance organizations that we provide credit for micro-entrepreneurs, for housing improvements, for childhood education. We have a savings product, we have an insurance product, we're about to roll out a remittance product. Big picture with regards to, and I think importantly, we are the only financially self-sufficient or only profitable microfinance entity in the entire 13-nation Pacific Islands Forum region. And that is not for lack of effort. There have been lots of donor groups over the years that have tried to start microfinance entities in these regions, and they have all failed. And it's not for lack of having high interest rates either, or for lack of putting in large amounts of money, because they each put a lot more money in than we put into SPBD. Generally, it's poor management, and it's not for lack of wanting to do good. These are all stakeholder-driven organizations, as opposed to SPBD, which is really a shareholder-driven organization with very good intents. And so to me, I think that if you really, I got into this back in 1999 for the desire to make a difference as opposed to get a return. But if you really want to make a difference, there are 3 things where you can do that. One, you've got to have that organization be financially self-sufficient. If the organization is not financially self-sufficient and it blows over in 3 to 5 or 10 years, like most of these organizations that have been donor funded have, then you haven't really made a lasting difference. 1. 2, if you really want to make a difference, you got to have an organization that is scalable, that can go out and keep spreading and spreading and spreading. If the organization is not like that, then you're only making a modest difference. And 3, you've got to be willing to invest in creating new products and services and technology to drive down your costs. And if you're not doing that, then you're not making as big of a difference to your clients as you possibly can. And it's my assertion that shareholder organizations, as opposed to stakeholder organizations, do a much better job at ensuring financial self-sufficiency, ensuring scalability, and ensuring innovation because they are customer-focused. And I can give heaps of examples of donor-driven organizations or stakeholder-driven organizations that are not as customer-focused as our shareholder organizations.
Thank you. Good morning. My name is Carlos Danel. I am co-founder and executive vice president of Compartamos Banco. Pleased to be here and thank Pepe for this invitation. Just briefly, a snapshot of who Compartamos is. We're a specialized microfinance bank based in Mexico, currently serving just over 2 million households with financial services. most of it being working capital loans to micro entrepreneurs, as well as some housing products, some microinsurance products, and starting to develop our own savings products throughout the country. We have 10,000 people in staff, a portfolio of about 10 billion pesos, and essentially the history behind Compartamos, as you might know, we are a 20-year-old institution born in the early 90s in Mexico City as an NGO, eventually transformed into a formal financial institution in the year 2000, and then into a commercial bank in the year 2006, just to give you an idea of how that story developed, and addressing the point specifically about sometimes the motivations of NGOs transforming into the commercial model of for-profit institutions. As I mentioned, we now serve 2 million customers. By the year 2000, after 10 years of running Compartamos, the NGO, we were able to serve 60,000 clients, pretty much because we found ourselves in an environment back in the early 90s in Mexico, where very differently from other places in Central and South America, where the donor community was very present, Mexico was in a whole different mood. It is a middle-income country at that point in time, signing NAFTA with the U.S. and Canada, entering the OECD. So far from being a recipient of the international cooperation, it was a member of the international cooperation. So we really struggled in a way to grow and take the services. And again, Compartamos was born out of the belief that we are a social venture, committed to creating three types of value: social value, economic value, and human value. And when we talk about social value, we've always been very explicit that what we're searching for is to provide access to financial services to as many people as possible in the least amount of time. And having a very constrained base of funding through those first 10 years was a real struggle. After converting into an institution within the markets, of course, the exponential, if you will, growth followed, and now reaching 2 million customers. Also, as you might well know, in the year 2007, actually this month, 4 years ago, we were the first microfinance institution to do an IPO in a public market in the Mexican Bolsa, a transaction that was very successful and at the same time very controversial, that has created all kinds of, I think, very interesting discussion and debate about what goes on when something like that happens, when you bring in other types of stakeholders into microfinance institutions. And after 4 years, I've pretty much really come to understand that a lot of the debate and a lot of the concern, and I think it's a well-placed concern, is exactly about the potential, if you will, mission drift of having traditional, let's say mainstream investors participate in a microfinance institution in a way that it might then override or be a stakeholder that in a way undermines the benefits not only for staff but mainly for the clients of the microfinance institution. Clearly, after also 4 years and the results out there, just to give you a snapshot again, Compartamos has grown 3 times its size after the IPO. We still serve 98% women. Loan balances are still below $400. We've been able to diversify. We've been able to grow. Efficiency is better. Interest rates have kept coming down as they were before the IPO, and profitability still, because of the strategy that Compartamos has followed, is still what we call over average in an effort not only to build Compartamos but to also build an industry. So the facts are there of what actually happened, and to be very honest, I think a lot of these questions are not questions that are exclusive to institutions that do IPOs or that do commercial microfinance in any kind of venture, if you will, but sticking to our own little world of microfinance institutions, be it for-profit, non-for-profit, be it co-op, credit union, a bank, or an NGO. I think you have multiple multiple stakeholders. And the fact that I think the governance of the institution and management of the institution, in a great part, is about managing those expectations and managing the interest of different stakeholders. So yes, is potential mission drift a potential outcome of an IPO? For sure it is. But it's nothing new with an IPO. Potential mission drift is there from day one. When institutions are, have to meet the needs and the incentives of donors or clients or staff or management or so many stakeholders, then in each type of institution are present. So it is a lot more of an art than it is of a science. But again, I think it's precisely the core objective of having good corporate governance and management to be able to stick to a mission and to a vision that is clearly defined and that can align the incentives for different stakeholders.
Thank you very much, Carlos. Rosario?
Thank you to Pepe for having me here. I am Rosario Perez from ProMujer. ProMujer is a 20-year-old organization that really is not strictly only a microfinance organization. I would characterize our organization more as a women's development organization. In fact, the origins of ProMujer were not with microfinance. It started as a training group venture in the El Alto in Bolivia, where when there was lots of hunger and USAID and other institutions were donating food. And the two founders sort of got together, both of them teachers, and decided that they were going to take advantage of the fact that these women were coming in there to get the donated food, to train them on various topics, among which was how to build a business, how to run a business. And the women then said, after about a year, you know what, it's great to be trained on this, but we need money to make this happen. And these two ladies who really did not know much about finance, started giving small loans out of their pocket, until one of the ladies' husbands told her, who was in a development organization with the U.S. government, said, Lynn, you cannot do this. You got to do this more formalized. And that's how the whole microfinance portion of ProMujer started. So for us, in my point of view, is that, and I come from the private sector. I don't come from the microfinance sector. But my point of view is that it is not an issue of commercial versus NGO. I think it's an issue of, I think as was said here before, is management, having a client focus. And by the way, not all shareholding corporations have a client focus. We know that not only in banking, but in other institutions, in other industries. And I really do think it's in the commercial sector, there are good people and there are bad people, like in any industry. And so I personally think that the debate is put in the wrong light. I think that there are NGOs that are not very efficient and may not be as good for their ultimate beneficiaries as we think. We are, very much mission driven, because that's what we are here to do. And as a matter of fact, we probably at some point will want to transform the financial services part of our organization, because simply like in Bolivia, we have to by law now, and there are some benefits to the transformation. We also have other services, so for us it's very important to just keep our focus on what we do, which is women, and we are 99% women clients, and most of our employees are women. Not all of them, and we have 1,400 employees in 5 countries in Latin America, and we have about 220,000 clients. So, they are obviously, the commercial part of the industry provides, I think, they make up for serving 75% of microfinance clients. So I think that you can make the case that you need both. You know, after all, it started, microfinance really was an experiment of an NGO experiment. That's how it started. And, you know, it evolved in Latin America. It evolved into transformed institutions, particularly the first ones in Bolivia with Banco Sol and FIE, and then Peru, Mi Banco. And those are great organizations that do a great job of serving their clients.
Thank you, Rosario. So let's hear from Jacob.
Great, thanks very much. I'm Jacob Haar from Minlam Asset Management, which is a New York-based microfinance investment fund, which specializes in doing local currency investment in microfinance institutions globally. I think just generally, I mean, touching on many of the things that have been said, Carlos, I mean, I very much agree that it is about having multiple stakeholders, and as a debt investor, we would be one of those stakeholders, not one that directs, you know, policies and procedures per se as a board member or a manager, but ultimately it's about identifying successful business models which serve the long-term needs of a customer base. And you know, we work with NGOs. We have NGOs in our portfolio. We have regulated banks in our portfolio, and everything in between. And ultimately, it's not about structure, as other colleagues up here have mentioned. It's really about how the business is run, whether management is focusing on adding a valuable service to the marketplace that customers will use and benefit from. And if they benefit from it, then that institution will succeed both financially as well as having a social impact. So really, it's about identifying the proper business model for a market where you are providing a valuable service. Just leave it there.
All right. So we have heard the first round of responses from our panelists. And if I may paraphrase, the view seems to be that it doesn't really matter how the organization is structured, as long as the organization has a client focus and there is no mission drift. As the organization expands and multiple stakeholders come in, as long as you're focused on your mission, then it shouldn't really matter whether you're a for-profit organization or an NGO. And in fact, conceivably, if you're an NGO, you could be inefficient and you couldn't be serving necessarily in the best interest of your clients. Of course, my role is to instigate some further discussion. So let me just give you a couple of views on this. One is from Dr. Reddy, the ex-Reserve Bank of India governor, who took the view that perhaps some prudent regulation is needed in view of the extensive amount of capital that is flowing into this space and lacking institutions such as credit bureaus, credit registries. Potentially, you could have households taking on multiple loans when they can ill afford, leading to higher defaults and leading to potentially unsavory outcomes, both for the lenders or providers of financial services, as well as for the ultimate borrowers, who in fact are the constituencies that we are concerned about. So that is one point of view. Another point of view by Mohammed Yunus, and we can look at, for example, a Grameen model or the Brock model, NGOs or cooperatives, and you look at their return on equity, their growth over a period of time, quite phenomenal, but their return on equity numbers are not that phenomenal. You're looking at numbers like 8%, 12%, 15%. Whereas if you look at some of the for-profit organizations that I'm quite familiar with in India, like Spandana, for example, or SKS, they're routinely 40–50%. And they have grown dramatically, and they have delivered services to their constituencies. Now, One of the things that I think most of us would agree, and I would like to hear if this point of view is not generally agreed upon, is that as a microfinance institution expands and scales up, it is able to introduce further efficiencies, potentially improving its profitability. So part of the debate that I hear in the regulatory circles and from the likes of Mohammed Yunus is, well, what should be the manner in which these economies of scale should be divided up between different stakeholders? As you expand, as you improve efficiency, should that translate to some reduction in the interest rates on the loans that these households are taking? Or some part of it necessarily has to be kept inside to expand and further provide these services to additional stakeholders. So that's one question that I would like to place to the panelists. The second question that I would like to place is in the context of the IPO that was done by SKS. They actually created 5 mutual benefit trusts. And these trusts now look after, at last count, 6.8 million women. And they hold about $250 million of SKS equity. So the interesting question that arises is, clearly wealth was created for this constituency. What are some of the governance issues with so many women being represented? What kind of services these trusts should be providing? And should we think about, in future, a model, a governance model for handling issues of this sort? So I'm going to request the panelists to try and see if they can address these questions.
Great. With regards to the first question, the economies of scale, yes, as organizations grow, I mean, I think it's a little bit of a false, I don't like the question. The question has been raised by Yunus, and I just don't like the point of view. Big picture, I mean, he's suggesting there are 3 alternatives. 1 is to reduce interest rates, 2 is to invest in expansion, and 3 is to return money to the shareholder.
They're not necessarily mutually exclusive.
They're not mutually exclusive. And coming up with some sort of predefined formula as to X% should go to reducing interest rates, and Y% should go to investing in expansion, and Z% should go to return for shareholders. My viewpoint is that with regards to interest rates, they should be competitive with the market. Okay, and so always have a competitive product that your clients find good value in. And that's where interest rates should be set at. With regards to investing in expansion, if you can continue to invest in the organization and expand the organization so that the returns are greater than what your shareholders could get through an alternative investment, then that's a prudent investment. So make those sorts of investments. If, however, you have completely saturated your market, there's no more opportunity, you're just adding fat to the organization, then at that point you should be making a return to your shareholder. I don't think that, I think we are over-analyzing this, and I think that capital allocation considerations that are used for just normal companies, General Electric, are relevant for the microfinance industry, and that we shouldn't go out and create some new hybrid way of allocating capital. If we come up with restrictions and paradigms saying microfinance institutions need to allocate capital this way, then all you do is you limit the amount of financing that is going to flow into the microfinance industry. And that's a real shame, because today, I don't know what the number is, but certainly less than 20% of the world's people who could benefit from microfinance services are getting those services today. So there's room for extraordinary amounts of growth still in the microfinance industry. And if we come in, we put in all sorts of little fake mechanisms to say this is how capital has got to be allocated in the world of microfinance, that all you're doing is you're limiting the future growth of the industry, and you're hurting the opportunities for hundreds of millions of families around the world.
Let me just start probably by saying that clearly, again, this is, I think, one of the best things that happened after the IPO of Compartamos in terms of the debate is that we started off from a place where everything was black and white, right or wrong. And for some people, that's still the case. But I think largely in the industry, we've moved beyond that. And we've seen that, often even institutions that are commercial, like Compartamos, would make the case that, you know, the commercial model was the model to bring microfinance to scale. That clearly, if you look at the evidence today, is not the case. I mean, you have very big, be it non-for-profits in the forms of credit unions or co-ops or NGOs that have reached scale without being commercial. But also 75% of the institutions serving the clients today, or 75% of the clients, I should say, are being served by commercial institutions. So it is a mix of different types of institutions. And I think context matters a lot in which kind of model works why and where. I also think it's somewhat of a false debate. I think that, of course, regulation is important. I think we've known that for a long time, and in most places regulation is far from perfect, but things like credit bureaus, things like you know, regulation of mobilizing savings, and are of course very, very important. And I think the markets where you see that microfinance has been able to thrive more are places where that regulation is appropriate. But I fear that sometimes in these discussions we go from the lack of regulation to somewhat trying to be gatekeepers for an industry, which I think it's very unrealistic that we will ever be able to. I can remember 20 years ago when a few of us were going to the first, you know, microfinance trainings in Boulder, where we all talked about scale, we all talked about commercialization, we all talked about creating an industry. And somehow we got into a point where I think we naively think that we can be gatekeepers for an industry in which, for example, we say, well, you know, microfinance can only be done by institutions that have a double bottom line. Well, the fact is that I think that we might turn blue, say that until we turn blue. It's very unrealistic that if we're building an industry, we're only going to have double bottom line institutions. Now, double bottom line institutions might have a competitive advantage in the sense that they look at their clients and they target their clients and they serve their clients in a much better way than others. But that's for competition to actually decide. So yes, going back to my first comment, it is a balance, and it is more of an art of a science. So if you overprice your loan, you will lose your clients, I guarantee. I mean, anyone that has run a microfinance institution knows this. If you can't offer your investors a competitive risk-reward return on their investment, they will leave. If you can't pay competitively to your staff, for example, then you will lose your staff. So in a sense, management and governance of a microfinance institution isn't very different from the management and governance of any other type of enterprise. You need to align the incentives, and you need to make sure that all your stakeholders are well tended for. So in that sense, artificial ways of saying, well, for example, let's cap return on equity on microfinance institutions just because of the fact that it worked with low-income clients, I think, in fact, not only is very difficult to apply in reality, but also can create all sorts of perverse incentives. I know for a fact that if an institution is not, and again, we tend to look at this like, oh, well, high ROEs are a product of high interest rate. Well, not necessarily. High ROEs can come with lower interest rates if you're more efficient. But again, what is the incentive to become more efficient if ROEs are set fixed by regulation or by whatever means? So again, I think that sometimes we tend to look at this very artificially. Now, on the second question, of course, Compartamos did not have the clients participate in the equity of the institution before or after the IPO, as it did in the case of SKS. And I know they have challenges there with their trust and how they would be governed and how the clients actually benefit from that. And we've been often criticized for the fact that these were all either social investors or traditional investors that participate in the equity of Compartamos. But I think in essence, we believe, and I think David Rudman has done has articulately expressed this very well, is that when we talk to our clients, the first, the thing they want the most is to be well served. Good products, good pricing, convenient, in a way that it suits their needs. So the best way that they actually participate in the governance of an institution, I think, is not by sitting in a trust or sitting in a board. It's actually by buying or not buying your products. Because if they are not well tended to, they will leave. And again, if you've run a microfinance institution, you've seen that very practically happen. So I'm not sure. I don't have the experience of how these trusts should be governed, and I don't know how that benefit should translate to the clients. But I think, again, we're an industry, and I agree 100% with Rosario that for years and years, and to me it's still amazing that we're still talking about the institutions and we're not talking about client needs. So we're all, so worried about the supply-driven side of this. How should we structure each other? Should we be for-profit, not-for-profit, IPOs, debt? And we're not really, going into the tougher questions, which is, why is it that the products that we tend to our clients are still like Microfinance 1.0? And clients still have to adapt to us as microfinance institutions instead of us adapting to clients' needs, which I guess would be Microfinance 2.0.
Well, from my perspective, I do think that when you have in the places where you have a highly competitive market, and in my region, that's Bolivia and Peru, interest rates have come down significantly. So it is a benefit, but I think that the key there is competition. I do think that also the other thing that has helped in those two countries has been regulation. The central banks have understand that microfinance is a specific industry and it's different. And I think very different, for example, from Mexico and other countries where, it's not highly competitive. That's why in Mexico interest rates are very high for everybody. I do think that competition and regulation, and certainly I do think that the ability or the availability of good credit bureaus from a client perspective is very important because, we have that in Peru and Bolivia, and we use it a lot because there is a tendency when there are so many players in the marketplace for over-indebtedness. There's no two ways about it, and we have to be very careful and watch that out, both for the client, but also for the institution, because, everybody, look at what's happening in Nicaragua. Everybody got hurt. It wasn't just the clients, it was also the institutions that were serving. So, so I do think that's, it is important. I do think, though, that also there's a tendency to generalize in this industry. At least I'm new to it, but I see this. They're very different situations. The India situation is very different than the Latin American situation. And somehow in the press and everywhere, everybody, puts the same brush to, very different circumstances. In Latin America, there's differences between the countries. So that's more or less what I think. I cannot talk about the trust because I'm not familiar with that structure.
Fair enough. Jacob?
Sure, I keep having the benefit of going after everyone. So, I think there's, I agree that this choice is being set up as a false choice. We had a debate on a part of this issue with the Microfinance Club of New York, where we had two sides, both for limiting profits and for not limiting profits, and it was quite a lively debate. It's available online if anyone wants to take a look at it. But fundamentally, that was about, okay, should we restrict profitability of an institution, i.e., should we actually restrict the amount of margin that an institution is allowed to earn per loan? And I think that the clear challenge with that is on incentives, where if you are restricting the profitability of an institution. In the case of Mexico, there are a number of institutions in Mexico, and Carlos, you clearly know this market much better, but there are many institutions in Mexico which are not profitable, even with the high interest rates in Mexico, and have said that should large players lower their pricing, they would be pushed out of the market. Now that's competition, and that eventually will happen, and institutions will have to adapt. But this is, it's a more complicated issue, I think, of how loans are pricing. Certainly in Peru, we've seen loans go down from 75-80% to where they're today, between 25 and 35%. In Azerbaijan, where I was working for a microfinance institution prior to joining Minlam, there was an umbrella grant from USAID that had divided the country up into various regions, and different NGOs were given the administration of various different regions. They were not allowed to go into other regions and compete. And what happened is that when the umbrella grant ran up and the institutions started to go into each other's markets, pricing came down considerably. Institutions became better, and they did start serving the customers, not only in terms of pricing, but in terms of service and other issues. So clearly competition does work, but regulation is also, of course, required, and which is not something which I think we have to talk about regulation if you're going to talk about profitability and you're going to talk about how much you charge. I mean, there are various different models. Many countries with microfinance institutions deal with interest rate caps, and there are people who are for and against that. We've tended at Minlam to see that as not being the most productive way to deal with microfinance institutions, but that is a way. But certainly limiting profits creates misaligned incentives in terms of efficiency, in terms of expansion, in terms of ultimately competitiveness of that market. And on the trust issue, this is, as a debt investor, it's not something that we're particularly involved in, other than an awareness that the customers are ultimately being served, and whether that's the interest rate being decreased, whether they have involvement in the institution, that I think there's many different ways to address the issue. In Bangladesh, we've seen the government become involved with the Grameen Bank, where they represent the people who are owners of that bank. But on the SKS issue specifically, I'm not that familiar with that. Thanks.
Thank you. I think we have about 15 minutes rather than another round with the panelists. I think I may be serving the audience better by letting you ask the panelists questions. So I open the floor for questions from the audience.
I have a question regarding microfinance. You can all hear me. I have a question regarding microfinance plus services. And this relates to the ProMujer's model as a non-specialized or women's empowerment, women's development organization. Rosario, I'm sorry, I don't have the exact words you used, versus a specialized microfinance institution. And that then has implications on, I think it has implications on efficiency. There's mission that gets involved there. I have questions as to regulated versus non-regulated microfinance institutions and their role or their desire to do microfinance plus services. So I just, from your experiences, either with your organizations or the other, in your case, the organizations you've invested in, can you talk to how regulation might impact or limit or constrain a microfinance institution's ability to do microfinance plus services, potentially in the case of ProMujer Bolivia, or why your organization has chosen to specialize on microfinance, so financial services only? And do you see any benefit or value, since it's we're talking about being customer-driven, demand-driven. If your customers are demanding some health services or some other non-financial services, why are you not going there?
You want me to take it? in the case of Bolivia, because there were several questions in that question.
Sorry.
But there's no problem. We can still provide the health services and the training. In the case of ProMujer, it was, as I said before, it's in our roots. So the way for us, microfinance is not the end. The end for us is to make sure that these women, number one, become independent architects of their own destiny and have an impact on their children and their future. So that's really in a nutshell, what we are there for. Microfinance is just one instrument, which is basically economic empowerment. And we talk about microfinance, and that is both loans, insurance, savings, which I think are as important, if not more important than loans for these people. And then the other that we believe very strongly is training, because this training is a really important tool for them to get out of poverty and for them to get to feel good about themselves, but also to demand rights and to become equal with the male population. And the third one, which to me is very important and very exciting, is the whole health. And we are basically in ProMujer very focused now on making our health model sustainable financially in the next 4 or 5 years. So I think that is as important, if not more important, for what is our mission, which is getting these women out of this crisis mode.
I mean, in the case of Compartamos, just briefly, we focus on financial services, not because of a lack of wanting to serve other needs. In fact, we get a lot of information from our clients and a lot of demands, not only for healthcare, but for infrastructure, for training, for housing. There are so many things where this population is underserved or unserved that, I often make, and this is kind of my little speech that I always talk to students is, microfinance is just really the tip of the iceberg. If you really want to solve people's needs, there are so many other areas where there are so many huge opportunities. So I think in Compartamos, we've been of the idea that if we wanted to be massive and reach today 2 million and tomorrow 10 million customers, we would have to focus on something, out of mainly the belief that it is hard enough to do one thing well, let alone to do several things well. I think it's more of a challenge. So in that sense, I think we see our capacities are a bit more limited, and we wanted to focus on doing one thing and doing it massively. That doesn't mean that we're not involved in other efforts. We've set up a what is today probably the largest impact investment fund in Mexico for companies that are trying to do other types of services such as healthcare, infrastructure, housing, and education in the base of the pyramid. So we're there.
And just in terms of as investors, when we look at microfinance plus services, I think ultimately it's a decision as to whether or not this is a business line or this is a corporate social responsibility practice. And I think institutions should be clear about which category that would fall into, that activity would fall into. Certainly there's a case to be made that business development services and training can improve the customer's capacity to repay and their loyalty to the organization. But it should be clear how those resources are being used, and if they are indeed being used as to empower that community but also with a financial goal and a business line, then we can see the logic for it. But you do want to have clarity, and you want to make sure that the qualified, that yes, microfinance institutions have access to the bottom of the pyramid, and I know Victor McCool at SKS has talked a lot about the access, the distribution channel, and how that can be used. But you also need to make sure that the businesses which are being built to then serve that customer make sense and also do not taint the various products that one's offering. If you sell a, if you sell, I know, well, think of one example where there were solar panels that were sold to microfinance customers, and it turned out that the solar panels were not a very good product. And as a result, the microfinance customers did not repay their microfinance loans, which they had received to buy the solar panels. So, you need to be very careful about offering many different products out of one institution and focusing on the core business model in a way that works is what we would like to see as investors, because those are the companies that we think will be successful.
So, sorry. I have a question stepping back to the original investor, because I think part of the problem has been that the message that was explained to investors was quite simplistic, right? So you're doing good, you're making money, and it's always the same happy story. But the differentiation of the models is quite broad. So my question is, going forward, now that we're sort of aware of the harm that that can do to be oversimplistic in explaining this, what's being done at the sort of individual level, institutionally, at the fund level, and maybe at the industry level, to be clear to investors about what these different models are and what they can segment into, because investors have different goals, both on the return side and on the social side.
That was a comment, I take it.
Oh, it's a question.
Well, I'll take a shot at it. I think, one of the things that we learned from our IPO, and I've said this before, is that even though we had a very explicit and a very narrow definition of what we meant by social value, which I mentioned before, we weren't telling people that enough. And what we found ourselves was that in the real world, people have very different notions of what social value is. And if you don't clearly define and are very outspoken about what your specific goals are, then people will then hold you accountable to what they believe social value is. So I think as an industry, we're getting this better, and we're encouraging people to be a lot more explicit and precise about what they mean. I do see a tendency, however, to kind of try to come up with consensus of what this is. And I'm afraid that's an effort that's going to take a long time and will not get very far, in a way that indeed it is a very wide range from, trying to eradicate poverty to trying to just create financial inclusion. And it might seem trivial, but it's not. The differences, I think, are significant. But yeah, we all like simple, and we all like simple definitions, and to talk of things like if they were the same everywhere for each institution, every country, and every type of product. And, the sad news is that life isn't that simple, and one needs to go into the details, and one needs to respect, again, that different institutions are trying to achieve probably different things. I've said this before, but, two of our best competitors in Mexico are clearly two double bottom line institutions, and they're very competitive, and we see our clients go to them because of their products and the way. So again, to kind of artificially try to make everyone be like ourselves, I think it's not going to be very successful.
Yeah, I think that just having very clear messaging is what is important. In that, as an MFI, you can have a variety of missions. You need to be true to your mission, and you need to explain exactly what your mission is very clearly, and try to come up with various benchmarks so that your investors can understand that. My view is that one of the great benefits that MFIs provide is just providing access to financial services. I don't think enough of the general public understands that. Just getting access to financial services is a giant leap forward. Providing people, our clients, with meaningful economic opportunity is a giant leap forward. If those come at interest rates that are substantially higher than they are here in the United States, or credit card rates here in the United States, then that's not necessarily the main concern of the customer. Getting access to financial services, getting meaningful economic opportunity is a big thing. So one, just truth in messaging is sort of important. Two, I think it behooves the MFI to bring in investors who are like-minded. And so the MFI needs to be very conscious as to what sort of investors it's attracting. SPBD tends to be sort of more socially oriented than a lot of other MFIs. or commercially oriented MFIs. We're definitely a commercial MFI, but we're sort of on the social end of of that spectrum. And so I make sure that when we bring in investors, that they know where we are on that spectrum. We're not full-on communists, that's for sure. But we tend to be a little bit more socially oriented for the commercial investors.
I'm going to say just a quick comment that, I think the microfinance industry oversold itself. And now we're seeing the consequences. And in a way, it oversold itself as a poverty alleviation, as the greatest instrument since sliced bread. And I think that the benefit of what's happening today, and there's some positive, is that precisely that we have to be forced to say what is the objective, that you are, whether it's financial inclusion, be more specific. So I think that even though it's painful right now, I think it's a healthy trend.
I mean, just building on that, I was going to say, I think that this crisis in Andhra Pradesh and also I think before that in Nicaragua as well, is ultimately clarifying investors' intentions, which was the problem in the beginning. It used to be that investors would put a photo of a poor woman holding a melon, and that was, oh, okay, we're helping the poor. I mean, it's not good enough. You need to know, how do you measure impact, and that's a discussion. There's things like the Principles for Investors in Inclusive Finance that just came out, which is under the UN Principles for Responsible Investment. And there's a work stream specifically saying, okay, what are you doing? Are you putting covenants in place in your loan agreements? Are you or implementing policies and procedures at the board level? And just not setting certain requirements, but generally looking at very specific benchmarks and indicators to say, let's clarify what we mean by social. Let's look at measuring this performance and where we are within the spectrum. I guarantee that Sequoia, when they invested in India in microfinance, had a different intention in some ways than what the IFC did. They might have both talked about some social performance, but I assume that the vocabulary was different and the intentions were different. So it's very important for investors themselves, more than putting it on the MFI, but for investors themselves to clarify what their intentions are.
Hi. We just had a lot of discussion about investors. And I guess in my question really, so we've discussed investors and focused on sort of mission drift. And I guess one of my questions are just what are some of the most common requests that are made by these type of investors on MFIs when they come in and they'll ask you to compromise your original mission perhaps. And because Greg, you mentioned you weed out, you screen certain investors before they even come, before they even get to that point. What are the other type of investors asking? What are the most common requests that they're asking you guys for?
Well, I screen on both ends, to tell you the truth. I screen on investors who are too commercially oriented, and I screen on investors who are too ultra socially oriented. And so investors who want a very quick return, who are expecting a mandatory out within 3 years at certain multiples, and if they don't, then they get some sort of increased stake in the organization. So those sorts of investors I'm not interested in talking to because I have plenty of access to capital, and I don't need to take on those sorts of investors. We do have a number of socially oriented investors, and things that I have conceded to are to limiting dividends over very clearly defined periods of time. So maximum of 3 years. Dividends can flow from each of the MFIs up to the parent organization, but then they will be reinvested back into new MFIs and throughout the network into MFIs that need the financing. They won't go out to the ultimate shareholders for very clearly specified periods of time. So those are the sorts of concessions that I have made to socially oriented investors.
Yeah, I mean, briefly, I think it is key, in fact, that you know who, I mean, and again, let me just make this point once again. This isn't very different from any other type of venture. I mean, you really need to partner up with people that understand what you're doing. And you sometimes get it right and you sometimes get it wrong. And when you get it wrong, you have people that are demanding things that probably are not within what you're trying to achieve. I can remember clearly, I've told this story before, but in the year 2000, when President Fox came into office in Mexico, his big thing was microfinance. And we were just running the regulated financial company. We were just about to do our first issuance of debt in the local market. And he actually, announced publicly that he would fund our operations for 2 years, zero cost, because he loved it. And we had a very difficult time going back to him and saying, thank you, but no thank you. And even within the board and even within people, stakeholders in the company saying, well, this is enough money for 2 years, zero cost, why would we turn it down? And again, it was about, well, this is not what we're about. We want to, build a track record within the markets. We want to create an institution that can then go on and do certain things. So again, it's that consistency. And sometimes you get it right, sometimes you get it wrong. When you're a public company, in fact, you try to communicate it to investors in a way that they really understand what you're doing. But some of them, you either misrepresent or they misunderstand, and they eventually buy a stock that they don't want. And the beauty about an investment like that is, in fact, that it is very liquid. So I think we have, in the past, most probably attracted people. But even before they come and talk to us and say, well, why don't you do this or that, they've sold their stock. And yeah, it has an impact. But again, if you're managing based on the price of a share, then I think you have the the wrong scope and focus. So.
I think we've run out of time. I want to thank the panel members for taking their time out to share their experiences today with us. So let's give them a hand.